Over the next 2 decades, we're in the midst of the great wealth transfer where dollars will be transferring from one generation to the next. While it creates a lot of opportunities, it actually creates a lot of tax complexities as well. How do you need to start incorporating multi-generational tax planning into your financial planning? We're going to dig into that and more coming up. Welcome to the Wise Money Spotlight, our deep dive into a financial planning concept, all designed to help you take your next wise step in your financial life. Today, teeing up multi-generational tax planning strategies connected to the Great Wealth Transfer, all so that you can begin proactively planning today so that if and when that occurs in your financial situation, you're prepared and it can be very, very efficient. Back in the studio, one of the certified financial planners on the Korhorn Financial Group team, Brendan Handy, certified financial planner. Thanks for being here, Brendan.
Thanks for having me, Mike.
All right. Brendan's been on the team for several years, serves a lot of clients and a lot of clients that have very complicated tax planning and estate planning issues. And so, Brendan, from a multi-generational standpoint, you've actually had a pretty decent amount of experience dealing with this very topic that we're going to get into today.
A lot. And it's interesting because you talk more about emotions and less about finance. So it'll be interesting to get into that.
All right. Before we do, a hot take question here. What would you say? So Brendan also is one of the leaders on our tax team, does a lot of tax preparation as well as the planning work. Brendan, what would you say is maybe one of the biggest tax mistakes people make, just in general?
In general, I would say it's the lack of coordination with their advisors. And I can say that because it's hard enough internally coordinating. And so we have CPAs on our staff, enrolled agents. We also have certified financial planners. And so we know how hard it is to coordinate with the CPAs and EAs in-house. Imagine that working with out-of-house solutions.
Right.
It's incredibly difficult. And the problem is for CPAs, year-end's a busy time, but that's when you have all the data to do all the planning. And so getting your financial professionals coordinated so that you're not just arriving with your CPA in April saying, what are the results?
Yeah.
That, I think, is one of the biggest mistakes that happens.
Yeah. So just overall lack of tax planning. Yeah. I would completely agree. That's one of them, that certainly. And, with all the tax law changes that have occurred, and we're about to talk about, the big change with wealth transferring, I just don't even think it's not even a luxury anymore. It's a necessity. You have to be planning ahead for your taxes. And it sounds super boring. And not all of us are wired with the same interest or the same skill set. And yet this is no longer just a luxury or an option. It's a necessity that you're planning ahead for your taxes. I mean, thousands of dollars, tens of thousands of dollars hang in the balance.
Well, and especially it's hard enough when you have differing opinions. And so you have to have professionals that not only will say, hey, I'll send some emails back and forth with information so everyone's on the same page, but no, like collaborating and debating on what is the best decision to make in their comprehensive plan. That's difficult as well when you're not all on the same team.
Yeah. All right. Okay, let's get into the main topic here. So one of the big trends we talked about a little bit on the Wise Money Show. It's always part of the planning work that you're doing, the comprehensive financial planning work that you're doing. But it's what the culture is calling it the Great Wealth Transfer. Sounds like a novel or something like that. But what it really refers to is from the 2 generations, the greatest generation, I think is what they call it, and baby boomers. Over the next 20 years, there's about 84 trillion with a T that's going to transfer to the next generation. Experts say that maybe around 10 trillion of this is going to be going to charities or entities, with 73 trillion or so going to other individuals. And as we've talked about this before, anytime you hear that, you're like, all right, that'd be awesome. Like, let me stick my hand out. And yet at the same time, it's going to create a lot of complexities. And certainly from a tax planning standpoint, it could create a lot of complexities. And, I've heard some awful scenarios. I'm just thinking of one right now where someone shared that, a friend of mine told me they just inherited some dollars and then they did this and they realized that's not what they wanted to do. Is there any way that can be undone? And I'm like, nope, it can't be undone. That was a mistake. They should have been planning ahead, blah, blah, blah. So this is over the next couple of decades. Brendan, let's nerd out a little bit. I'm curious your thoughts on maybe 3 multi-generational tax planning strategies folks should be at least thinking of, depending on if this could be a reality and part of your planning in the future, or you're unsure because you don't know whether you're going to set to receive something or whatever. But 3 multi-generational tax planning strategies to be thinking about.
Well, and whoever named the best generation, I'm already feeling bad for whichever generation's the worst generation.
Right. The greatest generation, the not so greatest generation.
Yeah. Well, and to answer your question, Mike, I would ask you one. So, Mike, you're a 20-year-old college student,
Okay.
and I give you $19,000.
Mm-hmm.
What are you going to do with that $19,000?
Oh, golly. If I'm a college student right now, maybe going on a really fun vacation, or upgrading the vehicle, or I don't know. It's probably splurging.
Probably splurging. And so that's where my first strategy always, and I'm biased, I believe in comprehensive financial planning.
Yeah.
I'm a CFP. But the best gift that somebody can give their child is the gift of a comprehensive financial plan.
Okay, so you're right out of the gate. You're saying, Mike, when I think of this great wealth transfer and $84 trillion passing, or $73 trillion passing to generation, is those with the catcher's mitt and will receive it, are they financially ready? Is that that's what you're saying?
Financially ready. So I think what's the saying? It takes skill and character to manage money, and you can have both at 20 and neither at 60.
Yeah.
And so if you're thinking of giving money to your child or grandchildren even, well, I would be thinking, how can I equip them to make the best decisions with those dollars?
Mm.
And so that's what comprehensive financial planning is built for, especially for the younger generation where there's maybe not as much complexity, but what you're doing is, and it's funny because I have gotten to serve in a lot of different capacities here at KFG, but where I've had the most kind of, I would say, not realizing what I was expecting was working with the third generation of a first and second. Yeah. And that's because you're instilling family values from the first generation. You're absorbing, well, what is it to handle money in this family? And what values are we passing on? What kind of education can we provide this person so that, again, they're building these skills and character that they need to manage the money that will come one day.
Yeah.
And for some, you're doing this balancing act of, I'm going to tell them everything that Gen 1 has and is coming their way. For those that they can handle that and are ready. For others, it's you're being a little bit more discreet and saying, hey, there's going to be some money coming along the way. Let's get you making the right small decisions first so that when they become big decisions, you're ready.
Yeah. And I actually liked, so none of this is scripted, guys. All of this is just sort of organic. And so but Brendan, how you frame the question to me is 19,000. And I want to draw the distinction because we're talking about $84 trillion, and some might listen and say, well, yeah, if I was going to receive an estate, a large amount, then yes, that skill and character is important. But if I'm just receiving a little bit, then I'm fine. No. A little bit can accelerate you in the wrong direction as well, and can cause you to instead of having a blessing, have it be a curse or couldn't squander. Financial planning, before we get to the other two, I mean, that's really just the process. I talked in a Wise Money video here recently about having sustained success. It's college football playoffs right now, and Matthew Stafford, he was the example. Sustained success, pretty unbelievable. Nick Saban also has had sustained success, and he talks about not the result, but the process. He has been furious after some victories, even though the result was good. Hey, the process wasn't that good. And he has been very content in his own weird way after some losses because, hey, we approached it well, we executed well. It just, the result, it wasn't our day. And so the process, the first thing you're talking about, looking at all 6 areas of your financial life doesn't immediately give someone the character and skill, but it gives them a process to help infuse the right skills and bring in the right character for wise decisions.
And it probably kind of seems unstated, but if you're going to be inheriting or if you're going to be giving a child an estate one day down the road, I would do it in small chunks up front so that they can start building that skill and character.
Yeah.
Because the silent generation is one that said they did not talk about finances, did not talk about money. And I had a client where they inherited money that they didn't even know existed. They're like, we are not expecting anything. And all of a sudden, 2 million falls in their lap.
Yeah.
Think of all the decisions that could have been made leading up to that to
All right.
put them in a better place.
Now let's get more tangible then. So go on to second. What's your second sort of idea or thought or strategy when it comes to multi-generational planning?
Yeah, so the second one would be understanding what you're giving them. So obviously you can give them a vehicle that they might need. You can give them cash. You can give them appreciated securities. And so what a lot of advisors, especially early on, what I would think first is, hey, I'm looking at a client that's got their federal tax bracket for long-term capital gains is 23.8%, 20%, and then 3.8 for net investment income tax, which is a tax on your investments when you're over a certain income threshold. And you say, let's gift this stock to the child, have them sell it at their lower tax rate. They might be in the 0% federal tax bracket. Except don't forget about the state. The state has to get their cut as well. And so if you're expecting the child to pay no tax, you're going to get caught with a state bill that you may not have been ready for.
Yep. So in regards to knowing what you're giving, like you mentioned, so sometimes there is this tension. Sorry but this tension of, well, do I give or do I let them inherit? Do I give or let them inherit? So speaking of like some appreciated investments or some property, understanding what you're giving and whether it makes the most sense to give or inherit. You want to talk about that difference? Because that's part of the planning, the proactive planning work that you need to be doing.
That's right. And so a lot of folks also fall into a trap where I'm going to give this stock to them. They're going to get the basis on the day I gave it. Right. And they'll pay no tax.
That's right.
That's not how it works.
Correct.
So they inherit your basis as well. So if you bought Apple at $100 and it grew to $200 and you think, I'm going to give it to my child, they're going to pay no tax because they got it at $200. No, they're going to pay the tax on the $100 difference you've incurred.
When you give your tax basis, your cost basis. I know that's sort of geeky, but when you inherit, it's different.
Yes, and that's where if you inherit outside of an irrevocable trust, I'll make that clarity, but outside of an irrevocable trust, there's a step up in basis. And so let's say in that same example, you bought Apple for $100, it's worth $200 on the day that you passed away. Your heirs get a $100 step up. Yep. So if they sell at $200, there's no tax consequence. They sell at $205, well, then they're going to pay tax on that $5 gain.
The house, in prior generations, used to be the largest family asset. I do think we might be entering a time frame where houses are passed on from generation to generation. That might start happening again. I have seen it, I'm assuming you have as well, Brendan, that at the later stages of life, people have this feeling of, well, I need to give away the house before I pass away because I don't want, the nursing home to take it. I don't want someone to take it. I don't want taxes to take it. I need to give it away because it's a huge asset. And that's where this giving away the cost basis can be especially troublesome, but it also connects with some of the tax laws around when you sell a house as well. So I don't know if you want to touch on any of that.
Yeah, well, and that's where what some folks do is they, instead of giving it away or giving it to their kids, they might put it into an irrevocable trust. Well, that strategy was very common back when the IRS hadn't really ruled on what is going to be a step. Is there a step up in irrevocable trust or not? That has since changed. So there are likely a lot of houses that have been put into Medicaid trusts to try and avoid some Medicaid issues that when the heirs go to sell it, when their parent has passed away, they're going to realize a tax issue that they may not have expected.
Yeah. If you let the house transition when you pass away, so it's inherited, then again, it gets that same step up in cost basis. Oftentimes, this comes up when an individual later in life is maybe spending some time in an assisted living, but still have the house. And the thought is, well, I need to give it. Well, no, maybe you need to sell it, because if you sell it as the homeowner, you've lived in that house for 2 out of the last 5 years, and you get an exemption on the amount on some of the growth, $250,000 or $500,000. And that if you just gave it away and then your kids sold it, they would not get that exemption because they didn't live in it in 2 out of the last 5 years. Third kind of multi-generational planning strategy, Brendan.
Well, and that's where, just to close up the second one, if you're giving them cash, then it's where do we put that cash? And that's where working with a CFP, a comprehensive financial planner, to then go navigate what are the best tax advantage vehicles we can get that money into.
Right.
So that way they're getting dollars that would be growing after tax, accruing an IOU. They can maybe stuff into a Roth IRA or Roth 401k, and now you're leveling up that investment.
Love it. And multi-generationally, sneaking more dollars into tax shelters. Because
That's right.
if you are in retirement and looking at a giving strategy, you don't have earned income, you can't contribute to a Roth. But if your child or your grandchild is working and they are eligible to contribute to a Roth, you can give them cash, they can contribute to the Roth, and you've just really created a parlayed a couple tax strategies. So, all right, third one here, Brendan.
Third strategy is integrating everyone's plan. Okay. And so think if I'm working with first, second, and third generation, which believe it or not, does happen. Oh, yeah. And that third generation is probably in their early 20s. If you look at each situation in a vacuum, you're not going to make the best decision, I would say, unless you're extremely lucky. And so, for example, a client with about $2.5 million in a pre-tax account with 2 children with high incomes, if a second advisor who's not working with the parent is working with the kids, looks at their situation, they might say, you're a high earner, you're in a high tax bracket, let's fund your stuff pre-tax.
Right.
When they've got a large IOU coming when their parents pass away, because they're likely not going to spend through their IRA.
Yep.
That's a situation you can avoid if that was fully integrated and you said, hey, we're going to be funneling some Roth dollars in because we're going to take advantage of the pre-tax when you have an RMD on your inheritance.
Yeah.
When you have 10 years to take out your inheritance, that money's coming out with an IOU. You're going to pay tax on it. So now what you can do is flip that lever and say, I'm going to fund the 401k at that time pre-tax and offset the two.
Yeah. Yeah. Makes a ton of sense. Like weaving the plans together, integrating the plans. Again, I like how you said that. And often that includes, I don't know why, it just often to me seems like it includes pre-tax tax sheltered accounts, Roth accounts, as well as giving strategy, and fusing all of that together, knowing, well, what's important, who's doing what tax brackets are you in, and if you're charitably minded, are all sharing the same sort of, have the same generosity, or is it just one generation, and how do you make that a part of the plan?
Right. And so, because most of the generations that have been investing and saving, the Roth IRA wasn't around when they started.
Right.
And so the fact that you're able to have your third generation start growing tax-free investments for the long term for their retirement can help offset what's going to be coming their way.
Those are 3 perspectives for multi-generational tax planning directly from Brendan, who's been doing a lot of multi-generational tax planning. It is, he mentioned, not very uncommon. No, it's actually very common for us, if you're doing comprehensive financial planning, to be working with 3 generations all at the same time, because as dollars transition, hard-earned dollars that you've worked hard and been a part of your wealth building, as you transition from one generation to the next, to the next, to the next, you don't want a lot of those dollars like a haircut coming right off going to Uncle Sam. You want to keep it efficient and you want to fuse those strategies together. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on our team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.